Jerome Powell, isn't it? Ahead of tomorrow's Fed meeting and another expected 75-point hike. Let's get you up to speed now on yields. They too on the move. The 10-year gained 6 basis points to 3.518%. Its highest level since April 2011. It is now just below 3.5. The yield on the 2-year rose 8 basis points to levels not seen since 2007 and stands at 3.85. But what should be good times for gold? Well, they're proving anything but, taking another hit today. As you can see here on the screen, down marginally there, not as much as I had anticipated, relatively flat on silver and copper. The most actively traded gold contract, by the way, on pace to decline for 6 consecutive months, the longest such streak since 2018. The Fed's continued hiking, not only complicating things for gold traders, but also, of course, that strength of the U.S. dollar, which we talk about often. Rochelle?
Indeed. Well, for more on the markets, we turn to SEI Chief Investment Officer Jim Smigiel. So we want to really get your feedback here. Obviously, markets trying to digest a lot of different pieces of information here, and especially when you factor in what we heard from FedEx. What do you think the markets are really thinking right now ahead of this potential for this 75 basis point rate hike?
Hi, Rochelle, thanks for having me again. I think you're exactly right. It's just a wait and see. CPI really reset expectations in terms of where's for terminal Fed funds going to be. There's no more transitory in anyone's vocabulary anymore. So this is really just let's all wait till Wednesday and let's dive through the messaging. How hawkish is Chairman Powell and the FOMC going to be? We think 75 basis points is a done deal. We don't think we'll see anything more egregious than that. No 100 basis points in our view coming at this meeting. But the question for investors really is going to be, where's terminal Fed funds? Is we going to get to 4%? Are we going to even get closer to 5%? Where are we going to wind up in this tightening cycle?
Jim, what is your view on where you think we are going to end up in this tightening cycle?
I do think 4%, maybe a tad more, is probably where we find ourselves. Monetary policy is, it's delayed action. The Fed is well aware of this. This isn't anything new to the chairman or to the FOMC members. There's a lot of monetary tightening in the system already, and the full effect of that has really yet to be felt. So at some point, we're going to see a downshift here. And then at some point, we're not calling for a pivot, but at some point, the Fed is going to have to take a step back and pause and see what the moves, which have been obviously very significant. Let's not forget, we started this year off with essentially Fed funds at zero. There's a lot that they have to let play out in the economy. And at some point, they're going to take a step back and hold off. But we think that's going to be a ways from where we are today. We see 4% at a minimum for Fed funds.
And Jim, despite consensus on what the Fed do the last couple of meetings, we've seen some pretty volatile markets following comments from Jerome Powell. How do you expect they'll react to another 75-point hike?
I think he's really going to try to play it down the middle of this meeting. The issue with Jackson Hole was really an issue about the rally that we saw over the summer. I mean, if you're the Fed chairman, you have inflation running extremely hot, 8-9%. You've hiked twice at 75 basis points, unprecedented, and all of a sudden financial conditions are easing, markets are rallying. That's not having the desired effect that you want. So, that's where the rhetoric really had to turn a lot more hawkish. He really wanted to change expectations and let investors know that, look, they're serious. They really have to get things a bit more under control here. Financial conditions have to tighten. They have tightened since the Jackson Hole speech. They further tightened since CPI, and we expect that to continue. But the hawkish rhetoric probably would be throttled back a little bit with this meeting.
So what sort of opportunities do you still see in this sort of environment?
We're still kind of banging the same drum that we've been banging for a while, which is we're in an inflationary environment. We do see this inflationary environment as being secular, as I mentioned. We're certainly not in any transitory camp to the extent that anyone's in a transitory camp anymore. And that leads us to some key themes that we really think investors should take a look at their portfolios and see how they're positioned. Value equities, that's the first one. We've been big believers in value equity and leaning into value. for the last several years. We think that is still a position that investors should have today. So, if you've had a big tech overweight for the last number of years, that's where the performance has been. You really should start shying away from that and getting that value exposure into your portfolio. And then inflation-sensitive assets directly. Commodities and energy have been the place to be. There's no doubt about that. We still like commodities today. We still think there's room to run. Again, this is really more of a secular view from our perspective. Talk about the chronic underinvestment. So we can talk a little bit about the supply chain issues. Maybe even if demand comes off, we still see good support for the commodities market. We still feel it's fairly underinvested from a strategic perspective in client portfolios.
Jim, certainly the news out of FedEx last week really spooking the market. We are coming off the worst day that we have seen in years, yet all three of the major averages not too far from the flat lines. I'm curious, from your perspective, did you hear anything that changed your view just about whether or not the U.S. is headed for a recession and how big of a toll, I guess, a global economic slowdown could take on the U.S. here?
Yeah, it's a great point. FedEx is really a canary in a coal mine from our perspective, something investors should be taking notice of for sure. I will say we are a bit risk off right now. We like a little bit of a risk off positioning. We're not adding on any of these dips. And it really comes back to the situation that the Fed finds itself in, right? They are way, way behind them. They've kept rates too low for too long. And there are other issues out there. So we know that they have to raise rates and they have to tighten financial conditions, as I mentioned. But the case does remain, what are they going to do to a slowing economy? They're raising rates into a slowing economy. We are going to see unemployment start to head up. We are going to see economic growth struggle in the face of higher financing rates across the economy. FedEx is a great example of what's coming down the road. We're not calling for a very, very deep recession. But we are calling for economic activity to slow, and we do think that markets will not necessarily have that priced in as of yet. So we could revisit some lows from where we are today.
It sounds as though, Jim, you might want to pause a little sooner than the markets are anticipating.
In terms of investor behavior,
in terms of stopping.
It's interesting. It is they are between a rock and a hard place. Very, very difficult to pause when you're looking at inflation that is insanely stubborn at 8 to 9%. Do we see it staying there? Of course, no, we see it coming down, but we certainly don't see it coming down to where some break-even levels are suggesting. So we don't see a two handle on inflation anytime soon.
You think this labor market does need some of that pain, to use the Fed chair's words?
I think it does. I think that is, this is certainly not a goal of the Fed, but I do think that is going to be an outcome. Wages are lagging indicators. Wages are going to respond. The market is tight already, and with the inflation at levels where they are, you're going to see wages go up, and that is going to bite on earnings. We find it very hard to see a picture where we don't see earnings suffering going forward based on that. Doesn't mean that we're going to be in an earnings recession per se, but if you have market expectations where 2023 we have earnings up 8%, we're going to take the under.
Fair enough. We'll leave it there. Jim Smigiel, appreciate you being here. Thank you, sir.